This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
When a business starts to trade, there are, as we have seen, many taxes that may impact in terms of the running and operation of that business. There is, for example, an original decision to be made. When a business is set up, should it be set up as an unincorporated trade, for example, a sole trader or a partnership, or should it be set up as an incorporated trade, i.e. a company? That will impact seriously on how individuals and other entities will be assessed. If, for example, you go down the unincorporated route, then you must remember back to the early chapters. Chapter 4, what did we see there? That for the business profit and loss account prepared for the unincorporated trade, we need to adjust up that profit and loss account. Part of that adjustment of profits is dealing with the add back of depreciation and the substitution instead of capital allowances. Chapter 5, as I recall. We then look at the bases of assessment. How do we relate an accounting period that the sole trader or partnership have chosen to prepare their accounts to, any date in the year they choose? How do we relate that then to the tax year in which it is assessed? What are our bases of assessment? But what we know is once we have a tax-adjusted trading profit for the accounting period, then it is that profit that the individual is assessed on. The individual is charged to income tax on their adjusted trading profits. But if the business had been set up as a company, what then? Well, if it was incorporated, then, though the rules of adjustment of profits and capital allowances are slightly different, the basic rules are the same. But now for the company, we must prepare a tax-adjusted trading profit and move on, if necessary, to compute the taxable total profits. Those profits will then be charged to corporation tax, so we need to be familiar with corporate tax there. But the owner-managers of the company, they, of course, will then only be taxed on the money that they take out of the company. Well, how can individual owner-managers take money out of the company that they have set up and are now trading through? Well, in their position as owner-manager, as a manager, they will pay themselves a salary. How do we deal with salaries? Well, we know that that, of course, is employment income to feature on the income tax computation of the individual. We also know that so far as the company is concerned, when it pays wages, salaries to employees, whether that is the owner-manager or any other employee, salaries and wages are deductible expenses so far as the company is concerned. And on that basis, therefore, that will reduce the company's taxable total profit. The other way by which the owner-manager can take money out of his or her business, as an owner, pay themselves a dividend. Well, dividends, of course, are not tax-deductible for the company. Dividends are distributions out of the taxable profit. They're distributions, they're not expenses, so they don't achieve a corporate tax deduction. But then in the hands of the individuals, they are taxable income. Whether we pay any tax and how much tax we do pay will then depend upon the individual recipient. Are they merely a basic rate taxpayer, or are they now up into higher rate, or even indeed up into additional rate, to work out how much, if any, additional tax charge will apply? So we can set the business up as unincorporated, profits chargeable to income tax on the individual, incorporated, profits chargeable to corporate tax on the company, and the individual owner-manager is then charged to income tax on the money they take out of the company, be it a salary, be it a dividend. But in relation to the profits of the unincorporated trader, in relation to the salary paid to the owner-manager, there's another tax. National insurance contributions, of course, are relevant here as well. So there's a whole range of taxes that impact on the ongoing business. When you dispose of that business, then equally capital gains tax may be relevant there. If, of course, you give the business away, inheritance tax may be relevant as well. A whole range of potential taxes relevant in terms of the lifetime of ownership of the business. And now it is that having dealt with all those taxes that I've just made mention of, be it income, be it corporate tax, be it capital gains tax, inheritance tax, be it national insurance contributions, but now we turn our attention to value-added tax. And there's a tax that, when an individual starts a new business, the individual may be very concerned about, because they'll have no practical awareness of the operation of how the VAT system works. What, again, now some of you will be familiar with is the term value-added tax. If you live within the EU, you'll be very familiar with VAT. Even here in the UK, we'll be familiar with it, well, for another couple of years anyway, before we depart the EU, it would appear. But VAT you'll be familiar with. Those outside the EU, it may be a term that we are unfamiliar with, but you may be familiar with the term sales tax that applies there. Again, often there is a sales tax charged on the sale of goods to either other businesses or eventually to individual consumers. Our version of this is VAT, and that's what we now need to know. Now, it's a tax that is administered by and paid by the business. It is a tax that is ultimately incurred by consumers, as we will see. Right. Now, when a new business starts, probably one of, well, certainly in VAT terms anyway, the very first thing that they'll need to know is whether or not the business needs to register for VAT. And if it does then need to register for VAT, how do we go on to account for VAT? But firstly, the issue of VAT registration. What brings us into the VAT system, requiring the business to account for VAT and eventually to submit VAT returns? There are two issues when it comes to VAT registration. There is compulsory registration and, as we'll see a little bit later, there is voluntary registration. The first thing that we have to deal with is when is a business compulsorily required to register for VAT. And here there are two tests that may determine the business's requirement to register for VAT. The first issue that we look at for compulsory registration is, as you see here in your notes on chapter 25, compulsory registration based on historical turnover. We're going to look back, as we'll see, look back over the previous 12 months to see whether that turnover exceeds the VAT registration threshold that would then require that business to register for VAT. Now, we're obviously talking about a business. We're talking about traders here. Now, whether that trader is unincorporated or incorporated makes no difference. This is a taxation administered by businesses. Whether unincorporated, sole traders, partnerships, or incorporated companies makes no difference. All businesses will have to deal with VAT. Well, they'll have to deal with it in terms of administering the system if they register for VAT. So, the rules of compulsory registration firstly are historical turnover. Now, what we do is to look at the types of supply made by a business. And in VAT terms, the supplies that are made, i.e. sales made by the business, may be said to be either taxable supplies or exempt supplies. And when we look at taxable supplies, you will see here that there are two types of taxable supply relevant, at least in our syllabus. Most supplies are standard rated, which requires the business to charge an extra 20% on what would have been their selling price as the standard rated VAT. So again, very obviously, if here we were about to sell our goods for £100 and we are now VAT registered, then we're going to have to add on 20% and sell the goods for £120 to our customers. Clearly, therefore, making our goods more expensive than they would otherwise have been. And that, of course, may be an important issue in terms of whether a business does voluntarily choose to register for VAT or not. It, of course, may be the case, as with most businesses, that the level of taxable supplies they make is at such a level that it's not a question of whether they want to. As we see here, they will be compulsorily required to register for VAT. So, the business making a supply where the business's sales price would be £100 has to charge 20% VAT on top, therefore giving a VAT inclusive price to be paid by the buyer, by the consumer, of £120. If, on the other hand, it was zero rated, then it is still a taxable supply, but there is no VAT to charge, and therefore the price stays at £100. Now you may consider, why bother to have a zero rate? Now we'll see the relevance of supplies that are zero rated for the business in a few minutes' time. In terms of, if we are VAT registered, are required to deal with the sales that we make and charge VAT on taxable supplies at either 20% for standard rated, 0% for zero rated supplies. But only if we are registered for VAT may we then recover the input tax that is known, the VAT that we've suffered on the goods and services that we as a business have purchased. If they were inclusive of VAT, we, for example, were the buyer here, paying £120 to the seller, inclusive of 20% VAT on the vendor's sales price, can we as a business recover the £20 worth of VAT that we suffered? And what we'll discover is that if we make taxable supplies, though we are required to account for, as we call it on our supplies, output VAT, we account for output VAT on the sales that we make. These are the outputs, the sales from our business. On the inputs, on the purchases and expenses, we can then recover the VAT that we've suffered on those purchase costs, on the goods and services supplied by other VAT registered businesses to our businesses. Now that is as compared to if we as a business make exempt supplies. Now if we make exempt supplies, clearly they are not taxable. There is no VAT to charge. But although there is no VAT, the same as would have been the case, we remember, if we made zero-rated taxable supplies, this has a very, very different and important impact. That if we make exempt supplies, then we cannot recover the input VAT that we've suffered on the purchases of the goods and services. That makes our costs 20% bigger on such purchases and expenses than they would otherwise have been, which we'll see with examples in a moment. So, taxable supplies are, as we have just said, those that are either standard rated or zero rated. The trader is then able to register for VAT and must then account for the output VAT on the sales. As long as you make taxable supplies, then you are able, if you choose, to register for VAT. Again, we'll see in a moment the level of activity that would require us to compulsorily register for VAT. But if we are registered for VAT, and we do make taxable supplies, then although we have to account for the output VAT on the sales, when we sell for £100 plus 20%, i.e. £20 VAT, we do not get to keep all of that £120. The 20% sales tax, the VAT, belongs to HMRC. We have to account for that on VAT returns, normally, as we'll see later in these notes, on a quarterly basis. We have to pay over that VAT to HMRC. But we only have to pay over the excess of the output VAT over the input VAT that we have suffered on purchases and expenses, whether those purchases are either capital or revenue expenditure in nature. But if we are making taxable supplies, we can reclaim that input VAT. So we'll only end up paying over to HMRC the amount by which output VAT exceeds input VAT. Now we'll do examples of that in a moment, but again, just to finish off the things that we said about the different types of supply, if a trader only makes exempt supplies, that trader is unable to register for VAT and cannot therefore reclaim the input VAT, cannot reclaim the input VAT. Right, let's have a little look at an example just to understand the workings therefore in terms of the VAT system. Right, here we go, a little example I've prepared for you. If you want to make a note of that, and I'll talk you through it. We're told that a trader purchases goods at a cost of £60,000 including VAT. So we are buying goods from other VAT registered traders at a price of £60,000 inclusive of VAT. So there is input tax that the business has suffered on the purchases of those goods. The trader also incurs expenses. So we've got purchases that we've suffered input VAT on. We've got expenses that we've incurred that also we suffer VAT on. Here the expenses, £12,000 including VAT. So the suppliers of goods have invoiced us at costs of £60,000 and the suppliers of those services have invoiced us for expenses incurred of £12,000, all of which are of course inclusive of VAT. Our business has then got on to sell those goods for £100,000 at the moment exclusive of any VAT charge. So let's have a little look at how we would deal with this. First of all, let's assume that the business makes taxable supplies. Now those taxable supplies could either be standard rated, so we charge 20% on the sales of £100,000, or zero rated, in which case there'd be nothing to charge on the sales of £100,000. But so long as the sales that we make are taxable supplies and we are registered for VAT, then we can recover the input VAT on the purchases and expenses. So how much input VAT would that be? Now on the purchases, the VAT inclusive figure is 60,000. Now be very careful here. That is 60,000 inclusive of VAT. Remember what inclusive of VAT means. It means that on top of the seller's normal price, they have charged plus 20% of that selling price VAT, an extra 20% VAT. So it means that the price that we've paid to those vendors of £60,000 is their price plus 20% VAT. So it's 120% of what their otherwise sales price would have been. So if we're going to calculate a VAT inclusive figure, how do we calculate the VAT on that figure of £60,000? We do not take 20%. 20% was the figure charged on the VAT exclusive figure. This is now 120% of that figure, and we want 21/20ths of that figure. So on a VAT inclusive figure, we take 21/20ths. At its lowest common denominator, for ease of calculation there, you may realise that that is 1/6, but it is 21/20ths. Now put that through your calculator and you will discover, again, even without maybe through the calculator, 1/6 of 60,000 is £10,000. That is the amount of input VAT that we've suffered. The person who sold those goods to us would have had a sales price of 50,000 plus 20% VAT. Well, 20% on 50,000 would be £10,000. There is your £60,000 cost that we incurred. The vendor selling those goods to us, their price was 50,000 plus 20% VAT is another 10,000. So we had to pay our cost inclusive of VAT was 60,000. How much VAT is there in that 60,000? It is £10,000 that you see there. So if you need to calculate a figure of VAT, which you may very well have to do in answer to an examination question, the first thing you've got to do is to look at the given figure and read as to whether that figure is inclusive or exclusive of VAT. Because if you were told that the purchase was 50,000 exclusive of VAT, then you'd have to work out 20% VAT on the VAT exclusive price. that was 10,000. If, as is far more likely on a purchase, you're told the cost you actually incurred, which of course is inclusive of VAT, then you take 21/20ths of that VAT inclusive figure. And so we get input VAT of £10,000 that we've suffered. And then on the expenses, well, you should be able to work that figure out for yourself now as regards on that £12,000 inclusive of VAT, how much VAT have we suffered? So again, it's a VAT inclusive figure. You'll find that the numbers are of course very friendly here. Times 20 over 120, 21/20ths, 1/6 of 12,000 is £2,000. So we have suffered two lots of input VAT. Our input VAT that we have suffered for this particular period on the purchases and expenses that we have incurred amounts to £12,000. Now then, we will be able to claim that back off HMRC, where it is, as it is here, in relation to taxable supplies. So let's look at the VAT that we then have to charge on our sales. Now let's assume to begin with that our sales are standard rated. Now, if our sales are standard rated, remember the figure of sales, £100,000 exclusive of any VAT. So standard rated sale, £100,000 plus 20% VAT equals of course £120,000. So we would have issued sales invoices to our customers for the goods that we have sold to them amounting to £120,000, which included £20,000 of VAT. £20,000 of VAT. Now again, if that is the case, then we have output VAT on those sales equal to, now you can see what the figure is here, 100,000 exclusive plus 20% was 20,000, 20,000 VAT. The other way of looking at it, of course, was if you got a VAT inclusive figure, 120,000 times 20 over 120 equals, of course, again £20,000. So look at what we've got. Our output VAT that we've charged on the sales that we have made to our customers. Remember, that money is not our money, it belongs to HMRC, it is tax, it is value added tax. But against that we can offset our input VAT that we have suffered on the goods that we have purchased and expenses that we have incurred that were chargeable to VAT anyway, £12,000 of input VAT. So on a VAT return, normally produced, as we'll see later, on a quarterly basis, we account for the excess of our output VAT over the input VAT. So we would have to pay Her Majesty's Revenue and Customs that difference between the output VAT on the sales and the input VAT on the purchases and expenses. So on this particular period, for this particular business, the business would have to pay out £8,000 of VAT, that excess of output VAT over input VAT. But that was where we had the most likely type of supply that was taxable, standard rated. Think what would have happened if it was zero rated. If it was zero rated, then very obviously in terms of output tax, it would be zero. There would be no output VAT. So then on our VAT return, think what we would have if we were now dealing with zero rated supplies. Our input VAT would still be exactly the same. We have suffered £12,000 of input VAT. Our sales in terms of our output VAT on sales would be nil. So this time we have suffered more input VAT than there is output VAT. This time, therefore, we could reclaim
from HMRC £12,000. Instead of us paying them, they will pay us. We can reclaim from HMRC the £12,000 worth of input VAT that we have suffered. So look at the two types of supply, taxable supply that we may make, and we can see the impact in relation then to the amount, if any, of VAT that we pay over to HMRC. If we make taxable supplies, what is a constant is our ability to recover that input VAT. We will get back that input VAT if we make taxable supplies. We then got to see whether on the sales that we make as a business we have to account and charge for VAT. If we do, then we had output VAT here of 20,000. We charged more VAT on our sales than we suffered on our purchases and expenses. We owe to HMRC, it's not our money, it's their money, £8,000. Whereas, if we have merely suffered VAT on purchases, but we have not charged any on our sales, then we have no money to pay over to HMRC, and they will give us back the VAT that we've suffered. So the constant is the ability to recover input VAT, so long as we make taxable supplies. If, on the other hand, we had made exempt supplies, then, although in terms of input tax we will still have suffered the £12,000 worth of VAT on our purchases and expenses, the input tax that we can recover will be nil. Our input tax recovered will be nil, because we can only recover VAT on our costs in relation to the taxable supplies, the sales that we make as a business. Any input tax on purchases and goods, acquired, expenses incurred on services performed for the business, the ability to recover that input tax is based on the type of supply we make. Make taxable supplies either zero or standard rated, you get back the input VAT. But if you make exempt supplies, then, although you do not charge, of course, any output tax, that will be nil, you are unable to recover any of the input tax. Therefore, that input tax of 12,000 on your purchases, on your expenses, becomes a part of the cost base of the business. That therefore increases your costs by 20%. Now, what would be interesting here is for us to work out what, from an accounting point of view, would go through your profit and loss account in relation to these purchases, expenses and sales, based on whether the business was making taxable supplies or whether it was making exempt supplies. So you have a think about that for one moment, if you would, about how you'd now calculate the profit made by the business. Now remember, through the profit and loss account, as you should know anyway from your accounting studies, we will put there the figures of sales exclusive of VAT. Any VAT charged does not belong to us. It's then a question of what go in as your costs. If you're able to recover input VAT, so you make taxable supplies, then it's the net, the VAT exclusive figures that go through your profit and loss account. If you cannot recover input VAT because you make exempt supplies, then you incur the full cost, so it's the VAT inclusive figure. Look what will happen to the profits of the business based on the numbers that I provided to you there, please. So the calculation of the profit, therefore, now if the business makes taxable supplies, whether those are standard rated or zero rated, the sales figure, so far as the business is concerned, is £100,000. That is the price that would be charged by the trader. The only question is whether or not VAT had to be added. But the sales figure is the VAT exclusive figure, £100,000. The purchases. Again, if we make taxable supplies, we can recover the input tax in relation to those purchases and expenses incurred. So it's the net cost that goes through our statement of profit or loss. So our net cost of purchases is 50 and expenses is 10. So the total costs incurred, £60,000, the profit is £40,000. Let's compare that with if the business were to make exempt supplies. Now, again, just like with zero rated, there would be no VAT to charge. So if the business makes exempt supplies, the sales is still £100,000. Now again, that's going to be the same figure of sales, irrespective of whether or not we make taxable supplies or exempt supplies, and if they're taxable supplies, irrespective of whether they are standard or zero rated. So the sales figure 100,000. But if we make exempt supplies but have incurred costs inclusive of VAT, because we only make exempt supplies, we cannot register for VAT, and on that basis we cannot recover input tax. So our business will incur the full VAT inclusive costs. We will not be able to get back the input tax suffered on our purchases and expenses. So the VAT inclusive figures are, again, as we've written above, 60,000, 12,000, total 72. So our profit figures now only £28,000. So we can see the impact, therefore, of whether or not the business makes taxable or exempt supplies. Now, we've said here that if we make taxable supplies, then we have a right to register for VAT. If we do not make any taxable supplies, then you cannot register for VAT, and the consequential effects as we've seen in terms of your base costs. But if you do make taxable supplies, then as we've said, you may choose to register. We'll look at the basis of voluntary registration in just a short while. But the first issue that your client, your new business client, may be concerned with is when do they have to register? So what about compulsory registration? Right, let's have a little look then back at the note.
Now, when it comes to compulsory registration, we're going to see that there are two tests that may be applied. Firstly, the one that we've underlined here, that of looking at the historical turnover. So we're going to look back in time. How far back? Well, here in Note B, we can see what we do. A trader making taxable supplies, again, got to be making taxable supplies here to be able to register VAT in the first place. And then, of course, depending on the level of those taxable supplies, that will determine whether whether compulsory registration takes place. So here, must register for VAT if during. Now, we'll look back over the previous 12 months. At any month end, we count back over the previous 12 months to see whether the value of those taxable supplies have exceeded by this month end £85,000. So if, as we go through, we start to trade, for example, in month 1, we establish a level of taxable supplies. It might be 5, 10, 15, 20,000 pounds or whatever. We could add to that month 2, month 3, and we work on a cumulative basis until such time, maybe well before we get to month 12, but by the time we get to month 12, have we as yet exceeded 85,000? Now, from the month whose at month end we exceed 85,000, compulsory registration based on historical turnover kicks in. That said, there is one exception for that. VAT registration is not required if taxable supplies we determine in the following 12 months are not going to exceed 83,000. That's going to be the deregistration limit. Businesses traders come into the VAT system. They may also leave the VAT system if, of course, their levels of taxable supplies may fall. And the figures that we're talking about here are the figures before, i.e. exclusive of VAT. So we're going to count through month by month to determine within any period of 12 months what is the first occasion that by this month end we have exceeded £85,000. If so, then when must we notify and when will we be registered with effect from? So here in Note C, HMRC must be notified within 30 days after the end of the period when those taxable supplies have exceeded 85,000, when the total on any cumulative rolling total for a 12-month period, or less than 12 but no more than 12 months, if in that period we've exceeded in total £85,000. At that point, HMRC must be notified within 30 days of the end of the period. So let us assume, shall we, for the purposes of this example, that that level of £85,000 was exceeded by the 31st of July 18. So on a 12-month count back, only by 31st of July 18, the end of July 2018, this is the first time that we've now exceeded on that 12-month total our cumulative £85,000 compulsory registration historical turnover limit. So that is the month end, July 18, at which point we've exceeded the 85,000. Well, dead easy. When must we notify? Within 30 days. Within 30 days of the 31st of July would take us to the 30th of August. So we have to register by the 30th, I should say, of August 18, within 30 days of the end of that period in which we exceeded the £85,000 taxable supply level. But then, when will we be registered with effect from? At what point are we going to have to then start to account for VAT in the way that we have seen, having then to charge VAT in relation to the sales that we make? Because at that point, our sales prices are going to go up by 20% there. So at what point do we have to start charging VAT? From what point are we able to recover the input VAT? So the trader here will be registered from the first day of the second month after the limit was exceeded, or indeed, if you prefer, from an earlier agreed date with HMRC. If the registration limit was exceeded by the 31st of March 18, the business must register by the 30th of April 18, as we can see there, within 30 days, and would be registered with effect from, well, we hit that level, 31st of March, have to register there by 30th of April, registered with effect from the 1st of May. So looking at the example that we've got running here, we hit the level of 85,000 taxable supplies for the first time by the end of July 18, 31st of July. So we then had to register by the 30th of August, within 30 days there of that period end. We'll then be registered with effect from, well, here of course 2 months on from July is September, first day of the 1st of September 18. And from that point, we're going to then have to account for output VAT on the sales and then be able to look to recover input VAT. Though, as we'll see in just a little later note, hopefully in our next lecture or the one thereafter, there will be the situation that if you haven't registered for VAT immediately that you started to trade, and many small businesses of course will not, they will only register when they have to, using this compulsory registration rule here. On that basis, that if they hadn't registered from the beginning when they started to trade, then at the time they do register for VAT, here accounting for VAT from the 1st of September 18, there will be pre-registration input VAT that they have incurred. They'll have bought things, the trading assets, your stock that you buy and sell. They will have bought assets on which, again, we may have incurred input VAT. We will have incurred expenses on which, again, we'll have incurred input VAT. Are you then, at the point at which you register for VAT, able to recover some of that pre-VAT registration input VAT? And the answer to that question, as we'll see hopefully in our next lecture, will in fact be yes, we can. But naturally enough, there are rules, there are limits as to what it is that we are able to recover that pre-registration input VAT upon. Okay, so the idea now, therefore, is all about at what point over a cumulative period of 12 months do we reach that level of taxable supplies of £85,000? Where do we exceed that level? Now, there's a little example here for you to have a go at between now and when, well, we get back together again in our next lecture together. Here we're told we're dealing with a trader which is a company, Orchid Limited, and it commenced trading on the 1st of June 17, and its sales are as follows. So we can see here we go through from June of 17, and this information goes as far as July 2018. So we've got to see at what point, at what month end, have we got within a 12-month period prior to that, our cumulative total exceeding their £85,000. So you need to get your calculators out, which is why you're going to do this while I am away from you, and start counting through. June, July, August. Keep going through, adding in all of these numbers here, until you get to either 85,000 or the end of a 12-month period. Well, if we've started June, then by the end of May is where you'll have reached your 12-month period. Now, you will add up all of these numbers. If at an earlier date, it will not be the case. But if at an earlier date, the total, say, to the end of March exceeded 85,000, then you'd have to register within 30 days of that particular date. Now, that's not going to happen here. The figures that you get to by the end of May will not have exceeded £85,000. So remember, we're working on a cumulative 12-month basis here. So when you move on to June of 2018, you'll then have to exclude June of 17. Because if you didn't, that would be a 13-month prior period. We don't do that. We work on a 12-month cycle. So you'd be taking out the June 17 figure of 3,800, I think it is under there. Is it 3,800? Yeah, 3,900, I beg your pardon, lurking under there, and adding in 11,800. Does that increase take you above 85,000? If it doesn't, we move on to, we add in July of 18, and we take out July of 17. Now, pretty obviously here, that's the latest point we can be working to, by which time we would become liable to compulsory VAT registration. And then, of course, here are the requirements. When Orchid Limited will become liable to compulsory VAT registration, the date by which Orchid Limited must notify, so at which month end have we hit the compulsory VAT registration historical turnover limit, where have we exceeded 85,000. The date by which Orchid must notify, within 30 days. The date Orchid will be registered from there, well, the first day of the second month following that compulsory VAT registration, that period end where you've exceeded the 85,000. So I'd like you to have a go at that, and we'll have a quick review of it at the start of our next session together.